Friends, thank you for being here today. What if I told you that the financial stability we see on the surface is not a sign of health, but a carefully constructed mirage designed to mask a collapse that has already begun? And ask yourself this: if the economic indicators that preceded the Great Depression, the 1987 crash, the dot-com bubble, and the Great Financial Crisis of 2008 were all flashing red simultaneously right now, would you know how to spot them? We stand at a precipice that few are willing to acknowledge. History does not merely repeat itself, it rhymes with a terrifying precision. We are currently living through a sequence of events that mirrors, almost beat for beat, the patterns established in 1929. This is not a matter of pessimism or fear-mongering. It is a matter of data, historical precedent, and the undeniable laws of economic gravity. Today, I intend to walk you through the 5-stage sequence of a financial collapse, a sequence that has played out in every major crash of the last century, and demonstrate exactly why we are barreling toward a reckoning in 2026. To understand where we are going, we must first look back at the historical pattern that serves as our roadmap. In 1929, an economist named Roger Babson stood before a business conference and delivered a warning that made him a pariah on Wall Street. He analyzed credit levels, market concentration, and institutional behavior, concluding that sooner or later, a crash is coming and it may be terrific. The establishment laughed. Irving Fisher, the most celebrated economist of that era, publicly ridiculed Babson, declaring that stock prices had reached a permanently high plateau. We all know how that story ended. 47 days later, the market collapsed. Fisher lost his fortune and his reputation, dying in poverty. Babson, who respected the data over the narrative, made a fortune and secured his legacy. This story is relevant today because Babson wasn't guessing. He had identified a specific framework, a 5-stage sequence that signals a market cycle is ending. I have spent months verifying this framework against the crashes of 1987, 2000, and 2008. It holds up every single time. And terrifyingly, as we look toward 2026, the first 4 stages of this sequence are already complete. This brings us directly to the first stage of every major collapse, which is the credit explosion. It never starts with greed, it starts with debt. Before every crash, there is a period where credit expands significantly faster than the economy can absorb it. This creates a feedback loop where borrowed money buys assets, pushing prices up, which makes people feel wealthier, leading them to borrow even more. It feels like prosperity, but it is actually a trap. Today, we are witnessing what can only be described as the everything bubble. In 2000, we had a bubble in tech stocks, but real estate was stable. In 2008, we had a bubble in housing, but other sectors were relatively rational. As we approach 2026, we have achieved a statistical anomaly. Everything is expensive. Let's look at the valuations. Warren Buffett, the Oracle of Omaha, relies on a specific metric to gauge market health, the market cap to GDP ratio. Historically, this number sits around 100%, meaning the stock market is valued roughly equal to the economic output of the United States. At the peak of the dot-com bubble, a time of irrational exuberance, this number hit 140%. Today, that number fluctuates between 221% and 230%. The stock market is currently priced as if the United States economy is more than double its actual size. This is not sustainable growth. It is a hallucination fueled by liquidity. Furthermore, the Shiller P/E ratio, which compares stock prices to inflation-adjusted earnings over 10 years, paints a similar picture. The historical average is 17x. In 1929, just before the Great Depression, it peaked at 30x. Today, we are sitting at nearly 38x. Investors are paying valuations that implicitly demand perfect earnings growth forever, with zero margin for error. But valuations are just the symptom. The disease is leverage. Official margin debt sits around $750 billion, a high number, but one that drastically understates the reality. When we add shadow leverage, securities-based lending where the wealthy borrow against their portfolios without selling, we find another $800 billion. Then we must consider the derivatives market, specifically the explosion of 0DTE, 0 days to expiration options. These financial weapons allow traders to control massive positions with tiny amounts of capital, creating trillions in notional exposure that exists entirely off the books until it blows up. Beyond market leverage, we have a corporate and national debt crisis that is spiraling out of control. Our national debt has crossed $38 trillion. We have entered a death spiral where the interest payments on our debt now exceed our entire military budget. We are spending more to service our past than to defend our future. Corporate debt has exploded to over $10 trillion. But unlike previous cycles where debt financed innovation in factories, much of this debt was used for financial engineering, specifically stock buybacks to artificially inflate earnings per share. Perhaps the most immediate threat in this stage is the commercial real estate, CRE, refinancing wall. Over $1 trillion in commercial loans are coming due in 2025 and 2026. These loans were originated in a zero interest rate policy, ZIRP, environment with rates of 0% to 2%. Developers and property owners must now refinance these debts at rates of 6% or 7%. The math simply does not work. A building that was profitable at 2% is insolvent at 7%. We are staring at a wave of defaults that will leave banks holding empty, devalued assets, effectively freezing the plumbing of the financial system. However, crashes do not happen solely because prices are high. They happen because systems become fragile, which leads us to the second stage, the concentration trap. This fragility is often driven by the fact that a disproportionate amount of market value is held by a tiny handful of assets, causing the safety net of diversification to vanish. In 1929, the market was dominated by glamour stocks like RCA, Radio Corporation of America. Investors didn't understand the technology, but they knew the stock only went up. In 2000, the NASDAQ was essentially a leveraged bet on 10 companies like Cisco and Microsoft. Today, we have the Magnificent Seven: Apple, Nvidia, Microsoft, Amazon, Tesla, Alphabet, and Meta. These 7 companies now account for 30% to 35% of the entire S&P 500 index. Think about the implications of that statistic. The S&P 500 is the bedrock of global retirement savings, 401ks, pension funds, IRAs. It is sold to the public as a diversified investment, but it is no longer diversified. When you buy an index fund today, you're not buying 500 companies. You are making a massive leveraged bet on 7 tech giants. This concentration creates a systemic risk known as the passive investing trap. Every dollar that flows into an S&P 500 index fund automatically buys more of the biggest stocks, pushing their prices higher and increasing their weighting in the index. This forces the next dollar to buy even more of them. It is a momentum machine that works beautifully on the way up, but on the way down, it reverses with equal violence. If the Mag 7 drop, the entire market drops, triggering forced selling by the index funds, which drives prices down further. We are already seeing cracks in the narrative supporting these valuations, particularly the AI bubble. The market has priced these companies as if the current artificial intelligence boom will generate infinite profits immediately. However, the economic reality of AI infrastructure is hitting a wall. The massive capital expenditures, CapEx on AI chips, are being depreciated over 7 years on corporate balance sheets to make earnings look better. Yet, the technology moves so fast that these chips will likely be obsolete in 2 to 3 years. Companies are amortizing assets over a decade that will be worthless e-waste in 24 months. Moreover, there's a physical constraint: energy. The data center buildouts required to support the AI narrative face massive electricity shortages. The nuclear solutions required to power these grids are 5 to 7 years away. We are building Ferraris with no gasoline to run them. As competition heats up, with Amazon and Google developing their own proprietary chips, Nvidia's monopoly margins, the very margins supporting the entire market's valuation, will erode. When the profit narrative cracks, the concentration trap will spring shut. This brings us to the third, and perhaps the most infuriating stage: the smart money exit. Before every major crash, there's a distinct period where institutional investors, insiders, and the ultra-wealthy quietly liquidate their positions, while public sentiment remains bullish. They sell their shares to retail investors, who are often encouraged by the very institutions that are selling to them. In 1929, the Rockefellers and Morgans exited the market months before Black Tuesday. In 2007, Goldman Sachs bet against the very mortgage products they were selling to their clients. Today, the divergence between insider behavior and retail behavior is at historic extremes. Corporate insiders, CEOs, CFOs, and board members, are selling their own stock at the fastest pace we have seen in decades. These are the people with the most intimate knowledge of their company's future prospects. If they believed their stocks were undervalued, they would be buying. They are selling. Meanwhile, retail investors are pouring record amounts of capital into the market, buying the dip and maxing out their 401k contributions. The average American is providing the exit liquidity for the billionaire class. The most telling signal comes from Warren Buffett. As of late 2025, Berkshire Hathaway is sitting on a record $325 billion in cash and short-term treasuries. Buffett is not a market timer, but he is a value investor. His massive cash pile signals 2 things. First, that he cannot find any viable investments at current valuations, and second, that he is preparing for a collapse. He did the exact same thing in 2007. When the crash comes, cash is king. Buffett is positioning himself to buy America on sale, while everyone else is forced to liquidate. We also see this flight to safety in the fear gauge assets, gold and Bitcoin. Gold has smashed through records, trading above $4,400 per ounce. But pay attention to who is buying. It is not just jewelry lovers, it is central banks. China, Russia, and nations across the global south are accumulating gold at the fastest pace in history. They are hedging against the collapse of the fiat currency system they rely on. When the people who print the money start trading it for hard assets, you should pay attention. Bitcoin, too, offers a warning. Historically, Bitcoin acts as a leading indicator for the S&P 500, often turning 4 to 6 weeks before the general stock market. In late 2025, Bitcoin hit a peak and has since seen significant volatility and drawdown. If the pattern holds, the weakness in crypto markets is forecasting a broader de-risking event in the equity markets for 2026. However, a new risk has emerged in this cycle, the corporate treasury risk. Companies like MicroStrategy have leveraged their balance sheets to buy Bitcoin. If prices drop below critical debt covenant levels, these companies could become forced sellers, triggering a liquidation cascade that spills over from crypto into traditional tech stocks. I want to pause here for a moment because this is critical. When you see the richest investors in the world hoarding cash, while the media tells regular families to buy stocks, what goes through your mind? Do you think the game is rigged against the average person, or is this just a coincidence? I really want to know your perspective on this, so please scroll down and leave a comment below with your thoughts. While the smart money heads for the exits, the economy enters the fourth stage, a deceptive period known as the liquidity illusion, where economic decay festers beneath a stable surface. In this stage, surface-level economic metrics, GDP, unemployment, consumer spending, appear stable or even robust. But underneath the surface, the structural integrity of the economy is rotting. The liquidity that greases the gears of the financial system is draining away, and the data we rely on is becoming increasingly detached from reality. Let's start with the labor market. We are told the economy is adding jobs. We are told the unemployment rate is low. But even the Federal Reserve has begun to admit the truth. The numbers are wrong. Fed Chairman Jerome Powell and private economists have acknowledged that official job numbers are likely overstated by up to 60,000 jobs per month. When you adjust for this error, the reality is that the U.S. economy has likely been losing 20,000 jobs a month since mid-2025. We are in an era of forever layoffs. In 2025 alone, announced layoffs hit 1.1 million, the highest level since 2009, excluding the anomaly of the pandemic lockdowns. Simultaneously, hiring has frozen, down 35% year over year. ADP data suggests that these weak labor conditions are becoming permanent features of the 2026 economy. The unemployment rate has quietly ticked up to 4.6%, the highest since 2021, yet the headlines continue to proclaim a strong labor market. This gaslighting prevents the average citizen from preparing for the storm. The banking system is also flashing warning signs. U.S. banks are currently sitting on approximately $337 billion in unrealized losses. These losses stem from safe assets like U.S. treasuries that were bought when rates were low. As rates rose, the value of those bonds collapsed. As long as banks don't have to sell them, the losses remain unrealized. But if depositors get scared and demand their cash, a bank run, those losses become real and the bank becomes insolvent. We saw the tremors of this with Silicon Valley Bank and First Republic. The underlying structural issue has not been fixed. It has merely been papered over with emergency lending facilities. Finally, we must look at the consumer, the engine of the U.S. economy. The consumer is tapped out. Credit card delinquency rates have hit a 10-year high. In some demographics and areas, severe delinquencies, payments more than 90 days late, are exceeding 20%. People are not just missing payments, they are defaulting. We are also seeing the return of the lipstick effect. This economic theory suggests that when consumers can no longer afford big-ticket items like homes, cars, or vacations, they still spend on small, affordable luxuries like lipstick to maintain a sense of normalcy. Sales of these goods are rising, a classic recessionary signal that hides the broader destruction of purchasing power. Core inflation remains sticky at 2.8% to 3%, but when compounded by new tariffs and the cumulative effect of the last 4 years of inflation, the cost of living has become a suffocating weight. Real GDP growth, when adjusted for the actual inflation felt by regular people, is already negative. We are in a silent depression, masked by nominal highs in the stock market. This path inevitably leads us to the fifth and most volatile stage, the trigger that will define the outlook for 2026. The trigger is the specific event that turns a vulnerable market into a collapsing one. It is the match that lights the fuse. It is important to understand that the trigger does not cause the crash. The conditions created in stages 1 through 4 cause the crash. The trigger simply determines when it happens. One of the most reliable predictors of a recession is the yield curve inversion, when short-term government bonds pay higher interest than long-term bonds. It signals that investors have no faith in the near-term economic future. The yield curve was inverted for 16 long months. Recently, it has uninverted. Many analysts cheered this as a return to normalcy. They are wrong. Historically, the crash does not happen during the inversion. The crash happens immediately after the yuan inversion. The yield curve uninverting is the final warning siren before impact. As we look toward 2026, the technical setup for the stock market is dire. The S&P 500 is hitting major long-term resistance trend lines that parallel the highs of 2021. The market is overextended, exhausted, and running on fumes. The Federal Reserve is trapped. They are beginning to cut rates, but they are doing so into a deteriorating labor market, not a strong one. In the past, rate cuts have often preceded significant market drops because they are an admission that the economy is breaking. Rate cuts in 2026 will not be a stimulus. They will be a desperate attempt to staunch the bleeding of a recession that is already underway. So, what will this specific trigger be? We cannot know for certain, but the list of candidates is terrifyingly long. It could be geopolitical. An escalation in Taiwan or the Middle East could shatter the fragile supply chains that the global economy and the AI narrative relies on. It could be a Mag 7 shock. If Nvidia misses earnings or faces an antitrust breakup, the concentration trap springs and the passive flows reverse. It could be a sovereign debt crisis. With global debt levels at saturation, a loss of confidence in the U.S. Treasury market could spike yields and implode the banking system. Or it could be a derivative accident. With $600 trillion in notional value in the derivatives market, the failure of a single major counterparty could cascade through the system faster than central banks can print money to stop it. Before we conclude, we must address the most dangerous phase of all, a psychological trap that has ensnared even the most brilliant minds in history, and the hidden opportunity that lies within the crisis. It is the phenomenon of the melt-up and the mechanics of the great wealth transfer. Economic history teaches us that the final stage before a collapse is often not a slow, orderly decline, but a euphoric vertical explosion in prices. In the early months of 2026, we may see the S&P 500 surge to 8,000 or beyond. Analysts will likely predict a roaring 20s scenario, fueled by larger than normal tax refunds, potential stimulus measures, and the final frantic gasp of the AI buying frenzy. This false dawn is the most dangerous moment of the entire cycle. When your neighbor is boasting about 20% returns in a single month, when the headlines scream new all-time highs daily, and when the bears and skeptics are mocked for missing out on the party, the psychological pressure to capitulate and buy in becomes almost unbearable. This is the fear of missing out, FOMO, weaponized against the public. It is exactly the trap that Irving Fisher fell into in 1929. He mistook the final manic rally for a permanently high plateau. He extrapolated the euphoria of the moment into an infinite future. Do not be fooled. This potential vertical move is not growth. It is the final sucking sound of liquidity, drawing every last retail dollar into the market before the rug is pulled. It is the distribution phase where the last of the smart money hands their bags to the public at the absolute top. If you see this melt up in early 2026, treat it not as a signal to buy, but as the final siren to seek shelter. However, we must also reframe how we view this incoming storm. In economics, destruction has a name: creative destruction, a term coined by the economist Joseph Schumpeter. Think of a financial crash like a forest fire. It is terrifying to watch, and it causes real pain, but it is ecologically necessary. It burns down the rotting deadwood, the zombie companies kept alive by cheap debt, the inefficient capital allocation, and the speculative bubbles that produce nothing of value. It clears the canopy for new growth and innovation. A crash is not the end of the world. It is a transfer of wealth. Wealth is never truly destroyed. It merely moves. It moves from the impatient to the patient. It moves from the leverage to the liquid. It moves from the unprepared to the prepared, to you, if you heed this warning. Consider the math of the collapse. In a bubble, cash is trash because it loses value to inflation while assets soar. But in a crash, cash becomes king. If the stock market drops 50%, a standard correction for the valuation levels we are seeing, a dollar held in cash today effectively gains 100% in purchasing power tomorrow. By sitting on cash, as Warren Buffett is doing, you are not losing to inflation. You are positioning yourself to buy high-quality assets, businesses, and real estate for pennies on the dollar when the dust settles. Furthermore, we must look to the lessons of the Weimar Republic hyperinflation of 1923 for the ultimate hedge. When the currency collapsed and paper assets became worthless in an afternoon, who survived? It wasn't just those with gold. It was the doctors, the carpenters, the engineers, the farmers. The only asset that cannot be inflated away by a central bank, taxed to zero by a government, or crashed by a stock market algorithm is your human capital, your skills. In a recession, unskilled labor is vulnerable, but problem solvers are always in demand. The best hedge against the chaos of 2026 is to become undeniably useful to your local economy. While the financial economy burns, the real economy of goods and services will remain. If you are finding value in this analysis and want to stay one step ahead of the events unfolding in 2026, please take a moment to like this video and subscribe to the channel. It really helps support this work and ensures that these warnings reach the people who need them most. So, where does this leave us today, and what is the ultimate conclusion we must draw from this data? The soft landing is a myth. It is a liquidity illusion designed to keep you invested, while the smart money heads for the exits. The data is clear. We have debt levels that exceed the Great Depression. We have market concentration that exceeds the dot-com bubble. We have insider selling that exceeds the 2008 crisis. And we have a labor market that is being statistically manipulated to hide the pain of millions of American families. The window for preparation is closing. The year 2026 looms not as a year of recovery, but as the year the bill finally comes due. Roger Babson was ridiculed for his warning, but he prepared. He bought hard assets, he reduced his debt, and he held cash. Irving Fisher believed the hype, and he lost everything. You now have the same information that Babson had. You understand the 5 stages. You can see the pattern. The only question left is, which history will you repeat? The one of the prepared or the one of the victim? The warning has been given. The choice is now yours. Thank you.